In today's business landscape, one of the most critical aspects of success is effective inventory management. Now, you might be wondering, what's the big deal about inventory? Well, let me tell you, it's not just about counting how many notebooks or envelopes you have on hand. It's about understanding the very heartbeat of your business. Today, we're diving into a topic that might seem dry at first glance, but is absolutely vital for any company, especially one like Greenleaf Paper Co., that prides itself on quality and customer satisfaction. We're talking about the costly effects of inventory understatement. Imagine this, you run a reputable paper company, offering everything from rims and envelopes to labels and stickers. Your customers love you, your sales are steady, and you're feeling good about the future. But then, suddenly, you discover that your inventory is understated in your financial statements. What does that even mean? Simply put, it means that the value of your inventory, the stuff you have in stock, is recorded as being lower than it actually is. It sounds minor, right? But hold on. The implications are anything but small. Let's break this down. Accurate inventory management is like having a good GPS for your business. It helps you navigate the tricky waters of planning, purchasing, production, and sales strategies. When you have a clear picture of your inventory, you can meet customer demands promptly, keep your supply chain running smoothly, and make informed decisions. But when that inventory is understated, well, it's like driving blindfolded. You could crash at any moment. First off, when your inventory is understated, it distorts your financial statements. Inventory is a significant asset for any business. It's not just a number, it plays a crucial role in calculating your cost of goods sold, gross profit, and overall financial performance. So, if you're underreporting your inventory, you're overstating your cost of goods sold. That means your gross profit looks smaller than it actually is, which can mislead you and anyone else looking at your financials. Imagine showing your investors a profit margin that's not really there. They're going to start asking questions, and trust me, you don't want that. But it doesn't stop there. Understated inventory can also lead to poor decision making. Management relies heavily on accurate inventory information to make strategic choices about production levels, purchasing, and pricing. If you think you have less inventory than you do, you might underestimate demand. What happens then? Stockouts. You're left with empty shelves and unhappy customers. The flip side is also true. If you overestimate demand because your inventory numbers are off, you end up with excess stock. That ties up your working capital and increases your carrying costs, not to mention the risk of obsolescence. It's a tightrope walk, and a misstep can cost you dearly. Now, let's talk about some common causes of inventory understatement. One major culprit is inadequate inventory tracking systems. If your systems are outdated or ineffective, you're going to struggle to record inventory movements accurately. This can lead to discrepancies between what you think you have and what's actually on hand. Then there are human errors, yes, those pesky mistakes that happen during data entry or calculations. Even the best of us can transpose numbers or miscalculate, leading to a ripple effect throughout your inventory records. Internal control deficiencies are another key factor. If your company doesn't have strong internal controls, you're opening the door to mismanagement and understatement. Think about it, if there's no segregation of duties or regular reconciliations, how can you trust that your inventory is being managed correctly? And let's not forget about damaged or obsolete inventory. If you're not properly accounting for these items, they can linger on your books, artificially lowering your overall inventory value. Now, let's get real for a moment. The consequences of understated inventory can be severe. Financially, it impacts your net income directly. Lower gross profit means reduced net income, which can affect everything from earnings per share to investor confidence. A distorted balance sheet with underestimated assets can skew your financial ratios, misrepresenting your liquidity and overall health. And we all know how important perception is in business. If investors think you're less profitable than you are, they might pull back on their support, and that's a slippery slope. Take Greenleaf Paper Co., for example. Despite their commitment to accurate inventory management, they found themselves in a tough spot due to a combination of factors. They implemented a new inventory tracking system, which should have streamlined operations, but during the transition, data integration issues led to incomplete recordings. When they conducted their year-end inventory count, they discovered the discrepancies. Without rigorous periodic reconciliations, these errors went unnoticed, leading to an understatement that had real consequences. The fallout was substantial. Greenleaf Paper Co. faced an artificially inflated cost of goods sold, which painted a false picture of their profitability. Decisions were made based on this inaccurate information, resulting in overestimating production requirements and ultimately leading to excess inventory. This excess tied up valuable resources and increased carrying costs. It's a classic case of how one misstep in inventory management can snowball into a much larger problem. So, what lessons can we learn from this? First and foremost, it's essential to implement robust internal controls. Without them, you're setting yourself up for failure. Regular physical inventory checks and reconciliations are vital. By routinely comparing your recorded quantities with physical counts, you can catch discrepancies early and make timely adjustments. Technology can be your best friend here. Advanced inventory tracking systems and automated data capture methods can significantly reduce human error and enhance accuracy. Training your staff is another key component. Make sure everyone involved in inventory management understands the importance of accurate data entry and adherence to internal controls. Knowledge is power, and well-trained employees can make a world of difference. And don't overlook the value of expert advice. Engaging with professionals who specialize in inventory management can provide fresh perspectives and solutions to prevent future issues. Regular external audits can also help validate your inventory practices and identify weaknesses before they become significant problems. In conclusion, the costly effects of inventory understatement cannot be overstated. For companies like Greenleaf Paper Co., accurate inventory management is not just a regulatory requirement, it's a critical component of financial health and business success. The consequences of inaccuracies can ripple through every aspect of your organization, from financial statements to operational efficiency, strategic decision making, and investor perception. So, if you take away one thing from our discussion today, let it be this: prioritize your inventory management practices. Invest in the right systems, train your staff, and regularly assess your processes. By doing so, you'll not only safeguard your financial reporting, but also pave the way for sustained growth and success. Remember, in the world of business, knowledge is power, and accurate information is your most valuable asset. Thank you for tuning in, and I hope this sheds light on the importance of inventory management in your business journey.